I need some traction. You need some traction.
Hi, everyone. My name is Lloyd Lobo. I'm the co-founder of Boast AI and Traction Conf. Super excited to have Anil Advani from Inventus Law, one of the most popular startup law firms in Silicon Valley. Anil's a popular lawyer, startup lawyer, investor, and mentor to startups in the US and across the world. Super excited to have him today give us the anatomy of a venture capital term sheet, break it down for us. What are valuations? What are preferred stocks? Things like that. What are your exit options, optionality, and all of that good stuff. This webinar series is brought to you by Boast AI Launch Academy in partnership with our friends at BCF Ventures, Lazaridis Institute, and Founder Institute. Without further ado, Anil, take it away.
Thank you, Lloyd, for that warm introduction. And yes, I mean, so this is always a area of interest. I've been practicing law for over 21 years in Silicon Valley and worked with over 3,000 startups. The reason I started my own firm, Inventus Law, around a little over 11 years ago, is to be able to provide founders really, the ability to negotiate in a more sort of balanced manner with VC investors. Historically, what had happened is VCs would come in with their term sheet, with their lawyers. Many times, VCs would actually require founders to work with the lawyer that they would suggest. So it was always imbalanced, right? The founders didn't seem to have a leverage. They didn't understand what they were signing up for. They always looked at, the dollars, whether they were getting the right number of dollars, and that was it. So that imbalance created obviously legal issues for founders. We've heard stories of, very well-known founders, obviously in the history. Steve Jobs was fired from his own company, as he said, his own company that he started. Uber founder, and there are a number of smaller sort of issues or founders companies that have had these legal issues. So the whole purpose of creating the firm as a separate sort of more founder-friendly firm is to provide that balance and advise founders on what they're getting into when they negotiate a venture capital investment term sheet. And that's the purpose of this discussion. I tend to do it very high level, hit on mostly business issues and legal issues that have bearing on founders, equity ownership, control rights, so that you can get a full perspective of what you're getting into. So the scheduled agenda will be simple. I'll have 5-6 slides. I'll run through them with my perspective, thoughts. We'll keep another half an hour, or we can extend it as needed at the end for Q&A, and I'll pick up the questions and respond. So, and obviously, if multiple founders are asking the same question, and we'll tend to spend more time on those questions as we can. So without further ado, I want to give, let all of you soak in the brand Inventus Law. That's our logo. We are the global technology law firm. We call ourselves that, and we have a trademark, so nobody in the world can call themselves that. So there's that, and we also work with founders from across the world. We are based in Palo Alto, Silicon Valley, but we have clients in all of those shaded areas around over 35 countries. Mostly coming in, setting up businesses in the US to be able to access capital, work with investors and customers, and set up businesses like a typical, either IPO or other exits to US investors or acquirers. So without much further ado, I'm going to get into the presentation. As I said, we have a little under 25-30 minutes, and then we'll get into Q&A after that. Valuation, and as you can imagine, in any term sheet that, as I mentioned earlier as well, in any term sheet, valuation becomes a hot topic, right? And founders and investors, that's the starting point, right? If you don't have agreement on the valuation, there's no point getting into the other terms of the term sheet or investment. So when founders come to me and say, we are talking to this XYZ investor, my first question is, have you talked about valuation? Is it the right investor for you? If you're looking to raise $10 million and the investment firm is a small investment firm that, let's say on their website is we invest up to $1 to $2 million, that's not the right firm. So there's no point talking about valuation or any other terms of investment if there's not even a fit in terms of the amount you're raising or the valuation you're looking to raise at and the stage of the company. So a lot of that information, and I would urge all founders to go on the website, do a simple Google search, right? Google.com has so much information now on the investor you're talking to. And you have no excuse. You have literally no excuse to not have information that's available on Google with a 30-second cursory search before you get into discussion with those investors or the VC firms. If you have that information, you can structure your discussions accordingly, right? If they're focused on healthcare or healthcare tech or ed tech and e-commerce, and they've invested in companies similar to yours, then you know that they understand some part of the business. So maybe also target your presentation so that it's less on the specifics of how big the market is, which probably they understand, and just a bullet point, and more on the actual nut bolts of what you're building, the technology, the team, and really how your unique proposition. So the valuation, how do you get to valuation? It's kind of simple in the sense it's a willing buyer, willing seller. You, the seller, the company is selling shares, and the buyer is buying the shares. So like any other asset that you sell, and I like to take analogies because analogies are useful for distilling down complex legal issues into more easily understandable business issues. So if you look at by analogy, when you're selling a house, right, what do? You bring an appraiser, you have an agent, the agent does a survey of how many homes were sold similar to yours in the same zip code. So you apply that and say, okay, before you list your house at market, you get that data and you say, okay, if a house with the same 4 bedrooms, same square size or similar sold in the last a month and the market hasn't changed for X amount, let's say $1 million, then that's your valuation, right? So that's how you put your, at least a number for the valuation. So that's how sort of apply that same basic logic and say, get the information, and people around you, the startup lawyer you're working with, the advisors you are bringing in, they all have that available, right, in some form. And they're also pitch book and other, and I'm sure Lloyd is, and his firm has a number of resources for coming into what's happened in the past, especially with the market that you're operating in. So use that as the starting point. Obviously, then you have to distill it into how desperate you are, how much leverage. If you're a seller, for example, of a house that needs to get out because you're moving, you're more desperate somewhat to sell. So you may want to discount a little bit and you're more eager to sell. If it's a good thing to have in the sense that you don't need the money, but you're thinking, you might as well take it to put oxygen into the next level of growth, you have more leverage, then that becomes your sort of balancing for your valuation. Similarly, if you think you're in a hot area, you're getting calls from investors, you have 5 or 6 investors lining up outside your door to put money in, then you become more aggressive and see which investor would buy it on the higher valuation. And again, the point I would also make is, just to be sure, valuation is not the only thing, right? It is a very important part, which is why we're starting for valuation, but it's not the only term. You also have to, and we'll get into it as we go into the presentation, but you have to think about also rights you have as a founder, who gets to make decisions on behalf of the company, who has control of the company. What happens if you and the investors don't get along? What is the implication for you personally as a founder, your stock ownership? Because you don't want to be in a position where suddenly, you've signed up with the investor with the right amount of money and valuation, but suddenly you're out of business. And then either you, because of vesting, you don't have stock in the company, or you have stock that can be diluted, or various other things. So again, the purpose of my living and working for founders is really on the work side, that is to help founders think, to understand what they're getting into. And then you make an informed decision. That's a decision, obviously, that you make based on your current personal circumstances. So how do you get to valuation? You look at the comps, as they say, around what's happened. VCs will throw in terminology, so that's why I want to make it easier. If you review this the slide, it says very clearly, you look at whatever the pre-money valuation is, add the amount of investment, and that becomes your post-money valuation. So if they say post this, premium, it's a simple math formula. Similarly, fully diluted capitalization, and this is important because what goes into fully diluted capitalization affects the percentage ownership that they will get, the investors will get, which by default also affects the percentage ownership that you as founders get, because at the end of the day, what they get and what you get and what any other shareholders get total has to be 100%. So if their percentage is higher, then yours will have to be lower to get to that 100%. So understand what fully diluted capitalization is. I always, before a client signs a term sheet, I always put together a cap table that shows fully diluted capitalization. So founders can look at and understand on the cap table what percentage ownership they will individually have as part of that investment round. So please pay attention to that part of it, not just the number of dollars, but where you will be personally. And there's some sort of a very high level formula on, at the time of Series A, Series B, Series C, what is the total sort of in a ballpark figure the founders should have. And that also depends on whether you're a single founder, multiple founders, 2 or 3 founders. But as a founder group, what is it that you should have maintained? And certainly at the first round of financing, Series A, that is institutional financing, you should have more than majority of, somewhere around 70% of the equity in the company. With a option pool built in, and we'll talk about that, possibly a little less, but somewhere around 50 to 70%, and again, based on circumstances. How do you, justify valuation? So you work with your advisors, your lawyers to come up with the right proposal on the valuation, but then how do you justify what the sales are, comps in the market? As I said, look at the investor. Some investors are $2 billion fund sizes. So for them to invest, much higher is not an issue. They have requirements internally, and this is very important. They have requirements internally that they will get 20%, or let's say in typical Series A, 30% of the company. So if you know that, and if you know that investors always invested X amount of money, but they've always got 30% of the company, that's not something you want to fight on necessarily, because it's not going to something they will change, or possibly in their fund document, they're committed to investors, so they cannot change. What you then want to fight on really, or negotiate really, is the amount that they will invest to get to the 30%. So a $2 billion fund may not care too much about putting another $2 million to get to the 30% versus a fund that's a $10 million fund. Obviously, you will struggle to get them to put $2 million overall. So, you have less sort of leverage in terms of the total amount you can raise. As I said, do your homework on the market. And I've also extrapolated terminologies from the actual term sheet, the NBS here form of term sheets that most investors in Silicon Valley at least use. And this is where the language comes in, right? The last investment, the last issue or item is very important to think about and keep in mind is many investors, especially in India and other parts of Asia, they sort of play this game. They'll say, okay, we'll invest $5 million, but we'll invest $2 million on day one or in 30 days, whatever that is. And the remaining $3 million will come in 60 days or 90 days, or the company meeting a milestone, right? If you get a certain customer revenues, or sign a customer, or bring in the team, or file patents, whatever those milestones are. That's dangerous for a startup, because that means that the investor is locking up the company today, saying that you will take money at today's valuation. Investors not obligating to put the money in, and then at least the second $3 million. And they're saying that $3 million will come in when you meet the milestone, which means basically the valuation of the company has gone up. So I just want to take this slowly, right? We run out of time. We have a lot of materials, but this part is important enough. If they're putting in $2 million today at today's valuation, that's great. If they're saying the remaining $3 million will come in because once you meet the milestones, what they're effectively saying is that $3 million, the company is agreeing off of today's valuation, let's say 20 million. But if you were to meet the milestone and raise money or that 3 million in 6 months when you met the milestone, the company's valuation may be 40 million. But they're not committing to put the money today, but they're locking up the company that the company will take that 3 million at today's 20 million valuation. So be careful about, that sort of games that investors, many investors, especially Asia-based investors, as I said, play with that terminology. Liquidation preference. So this is again more of a financial instrument, and very important. All preferred stock investors get preferred stock. Founders have common stock. Almost always, 99.9% times, investors will have liquidation preference, which basically means that if the company shut down and there's not enough money to pay everybody else, the investors get paid first, and that's okay, as long as it's a 1x and non-participating. If it's participating, then you have to think about whether that's the right approach, because again, whatever participation, that means the investors will get 1x off the top, whatever they invested, and then they'll get to participate in the remainder, which means it's coming from the founders or other common holders. So you want to be careful about how that liquidation preference is structured, because that goes directly into the amount of money that you will make as founders at the end of the day once the company is being sold. Again, I have some language extrapolated here for how liquidation preference is structured. And the key is, as I said, it should not be participating. It should be 1x non-participating. But there are different versions of that, right? There are fully participating, which is the other end of the spectrum, and that's dangerous. So I would say walk away from that investor, because what they're saying is they'll get the 1x, and then if they have 30% of the company, they'll get 30% of all the remainder, which means likely there's not going to be enough for the founders or the common holders to get. If it's participating with a cap, then that's something that you can negotiate with what the reasonable cap is. And based on, again, how early stage the company is versus late stage, what the risk profile is, the risk and reward sort of balancing there. And keep in mind, whatever you agree on today with your, let's say, Series A investor or even seed investor, that is what you will, the new investor will want, plus they will negotiate or look to negotiate even on top of that, right? So be very careful of what you negotiate, especially with your seed investors. And I tell my founders all the time, your first round of seed investors, the friendly angels that you like and that seem to like you, they are your angels because they're putting the first money in, they're taking the highest risk. But as you raise Series A, they become your biggest enemies. They become not enemies, but the biggest roadblock to closing a Series A, because they are the ones who will drag you back. The value of their investment has gone down. The value of the individual investor to the company would have gone down. And you as a founder want to tilt towards, being more closer and friendlier to the Series A investor because they're bringing in the larger money and they're also helping you. They will help you in building the business, bring the network in on all of that. And there will be almost always a conflict between institutional investors, small seed investors, and the Series A investors that are coming in. So it's also very important to structure your seed investment properly so that it doesn't come in the way of your ability to close very efficiently without a whole lot of conflict and friction your Series A investment. So pay attention to your seed investment rounds because that will come into play when you're doing your Series A. Again, there's a language here. It says, if this is the language you find in the term sheet, you should be good. And we negotiate again all the time with India investors or Asia-based investors. They tend to also get dividends. And Silicon Valley investors at least don't care about dividends. So they will put it into the term sheet that they'll get dividends, but dividends should be non-cumulative. What that means is at any time in the investment round, if the board approves dividends, then they get paid. But if a board does not approve dividends, they don't get paid, and it doesn't get tagged along to the liquidation preference. So that's important to make sure the any dividends that you're agreeing to are non-cumulative. They don't cumulate and they're not payable when the company is being liquidated as part of the liquidation preference. Again, I know there's lots of concepts here. I just want to highlight each of those and what triggers you should be looking for. So just to repeat on liquidation preference, as long as it's 1x non-participating, you're fine. On dividends, as long as they're non-cumulative, you're fine. Anything outside of 1x non-participating liquidation preference, you want to think about, and again, work with your lawyer to put a model in. Make assumptions, right? If the company sold for 100 million, what you as founders will get. If the company sold for 10 million, what you as founders will get. That will guide you into saying whether it's fair or not. And not just assuming now, but how much money you would have had to raise to get to the 100 million exit and what equity you will have at that point. Doing that exercise is very helpful for founders to see a clear vision from where you are to where you will be very likely to be, and how it affects you personally as a founder, how much equity or how much cash you get out of business if it's a low, medium to high exits. Do yourself that favor of building that model before you sign a term sheet. Similarly, if it says non-cumulative, just move forward. That's the best you can get and move on with that. So that's liquidation preference. It's all really an economic right. So in term sheet manners, you look at economic rights, which is valuation, liquidation preference, and then control rights, who's going to be on the board with decision making, and sort of we'll get into that in the next slides. So voting rights, as I said, these are protective rights, who gets to vote for on behalf of the company, for example. And as long as, and typically in the first round of investment, founders tend to control who will be on the board. So as long as you have control of the board in the first round of investment, you're fine. You can't get better than that. Institutional investor, at least the lead investor, will almost always get at least one board seat. So you look at, again, how structured and, how to structure the board so that as a founding group, you have majority control of the board. As I mentioned here, majority of the board makes decisions. So who's on the CEO, who gets hired, fired as CEO, CTO, CFO, all of those. And obviously you're going to be one of those as founders. So hiring and firing of your position in the company is depend on who controls the board. So be very careful about how those decisions are made and who gets to make those decisions on the board itself. They're protected provisions. These are veto rights that investors have. And again, almost always investors will have some veto rights. So Series A investor, institutional investors, they'll have the right, for example, that if you're selling the company, you need their approval. Or if you're raising next round of funding, they need to approve the terms of that funding. And that's okay. But you want to keep it limited to very material actions, right? As I say, every time you want to buy a pencil, you shouldn't have to go back to investor to get approval. You can't operate the business like that. Every time you're hiring an engineer, or if you're approving some sort of a simple option grant of 10,000 shares, 0.1, 0.2, 0.5 percent shares, you shouldn't have to go back to investors or the board to get their approval. So again, work with experienced counsel who can tell you what's good and what's acceptable and will not be an operational issue for the company, versus the list that can be, again, there's a big difference between, so the list that, that you can be agreeing on, and the list that can come in the way of your operational issues. And again, as I was going to say, there's a big difference between how investors in India, especially in Asia, other parts of Asia, perceive this versus how investors in Silicon Valley perceive. And as you negotiate term sheets, so hopefully you get term sheets for mostly Silicon Valley investors, but you'll see that, it's a very different mentality, mindset. Investors in India, they say that as founders, you're really promoters. It's like a family business. So whatever you do, we will hold you responsible, and you have to come and report to us, and we are the investors. Investors in Silicon Valley tend to take a different perspective, that we trust the founders, we are putting money behind the founders, and we trust their judgment more than, and we don't have the time bandwidth, and we are not the best suited to make those decisions unless it affects their rights, like sale of the company or raising more money. So they're usually okay with limiting it to material actions. And then again, your job is to understand what's material that you should accept, what's not material that you should push back on, and use experienced counsel and advisors to get there. I have language here again extrapolated from the term sheet. And this is where you plug in, the numbers of members, and this becomes a part of the shareholders agreement. So you're signing up that even though you may have majority of ownership in the company, you're agreeing that the investor, for example, will have the right to nominate, let's say, one board seat. So that's fine, as long as, again, majority of the board seat is held by or nominated by, or ability to nominate by, founders. Again, I'm screaming through this because I typically tend to ask questions, but we have half an hour at the end. So please keep adding your questions, and we'll deal with those at that time. Exit rights, again, very important. These are, again, similarly, they are good for the company if they're structured properly, which means that as long as there's a separate approval of the common holders represented by the founders, as long as the term sheet says we have the right to drag along, but as long as we get approval of the preferred holders, which is investors, and common holders, which is founders, that's good, because then everybody else who's signing up is agreeing that if there's an offer to buy the company, they're already agreeing to sell their shares in favor of that offer. So that's good. Many times, again, Asia and India-based investors force the company or founders to agree to terms where, let's say after 4 years or 5 years, if there's not been an exit, they have the unilateral right to sell and force the founders to sell the company at whatever price they get. And that agreement will be, that's something they push today on today's terms, so that you are signing an agreement that if they come back after, let's say, 5 years and say that, we have an offer to buy, to sell the company for, let's say, $10,000, you're agreeing today that you will approve that. And that's also enforceable in Delaware. So be careful about signing up to any of such drag-along rights. Redemption rights, investors have the right to force the company to buy the shares back. And as long as it's after a long period of time, let's say 7 years, so the founders have the runway to build an exit or a valuation where you can buy them out, and the value in the business that you can buy them out, that should be fine. But if it's anything less than 7 years, be careful, because, if you assume that you will exit in 3 years, it can take time, and now we are hitting with COVID. So anyone that signed up, 3 years ago that they will be exiting today may not happen, right? So what happens with that? The investors have the right to force the company to buy their shares at the fair market value. So if they invested 3 million 3 years ago, and the value is 5 million, and the company may not have 5 million today, and it obviously is not the best time to be using that 5 million, even if the company had it, to buy out the investors. So be very careful. Make sure you have a good runway. If you are agreeing to redemption rights, that you have a good runway, at least of 5, preferably 7 years, before the investors can trigger the redemption rights. Registration rights, again, are exit rights where the investors can force the company to register the shares in an IPO. It's not a big issue, again, as long as it's triggered after 5 or 7 years. And it's very hypothetical. In the history of the world and financings, at least I've never come across, and I've talked to a lot of practitioners who've been around for even longer than I, they've not come across any instance where the company was forced to, or the founders were forced to register in an IPO, because no underwriter will take on an IPO if the management, the CEO, the CFO, the CTO are not supporting that IPO. The market will not support it. But investors have this right. They like to have this right. And that's why I don't fight it, as long as, again, it's not triggered right away. We have a good 5 years, 7 years cushion to deal with that issue if it were to ever come. Again, very unlikely to come. We have 5 more minutes. I'll go through this slide, and I think that's the most important now, at least for the founder's perspective. And then we have another half an hour or so for Q&A. Founder vesting is very important. I mean, your stock should be subject to vesting. Founders come to me and say, why is my company, why should be subject to, I'm not going anywhere, which is fine. It's a good argument, but keep in mind, in almost all cases, as I said earlier, investors are investing because of the founders. So I hear this all the time from investors, and that I agree with that. In many cases, I don't agree with what investors say, and I typically support the founder's position because they worked for, they put a lot on stake for building the company. But in this case, investors are, especially at the early stages of Series A, Series B, investors are investing mostly because of the founders. And to say that, you can walk away with fully vested stock right after they invest is just foolish, right? No credible investor will put money where the founders have the ability to walk away right after the investment. Keep in mind, that's also something you have to think about in terms of protecting yourself against co-founders. So if you have 2, 3, 4 founders and you don't have any vesting, and investors put money into the company, one of the co-founders could decide to leave. And now you have a company which is valued quite a bit, and the co-founder has equity worth quite a bit, but the co-founder realizes he or she doesn't have to do anything to earn that equity. They can walk away. So it also puts the company at risk. It also puts the co-founders at risk. So keep that in mind when you're thinking about vesting, how that will work. Because as the key founder, the CEO, you're less likely to leave, and you're more likely that, you'll run into a conflict, especially if you have a large 3, 4, 5 member founding team. You're more likely to have conflict with co-founders who will be leaving. So you want to make sure the company is protected and they can't walk away with, fully vested shares. It's fine to negotiate some sort of acceleration to protect yourself, that if the investors come in, the board composition changes, or even within the founding group, if you're the third sort of founder who has 5% equity, and you're at the risk that the other 2 founders could turn around against you. It happened in Facebook. It happens more often than you'd like to think. If that were to happen, you're the 5%, then you should find a way to protect yourself and understand sort of what that protection is. At least, at the very least, you should be able to accelerate some part of your equity because you worked hard for it already. And as I said, I've represented over 3,000 companies, and I like to point out that every time I've seen founders split their equity 1/3, 1/3, 1/3. If it's half between 2 founders, I don't recommend it, but it's a different issue. But if you're 3 founders and 1/3, 1/3, 1/3, 100% of the time that I've been involved, not because of me to be sure, the founders have had conflict, and 1 founder out of the 3 has dropped out, or the 2 founders have ganged up really and said this third founder is not working, and results in conflict. So in those instances, if you don't have vesting, the third founder that the 2 main founders, let's say, don't agree with, or he's not performing, if you want to fire that third founder will walk away with 1/3 of the equity. At that time, that company will become non-fundable, because no investor will put in money into a company that has 1/3 of equity, dead equity, that the founder doesn't have to work for. So again, keep in mind how the vesting also affects you as founders with each other, is the intra-founder dynamics. Right of first refusal, again, very straightforward. That's nothing debatable as long as you have proper exemptions. But it's basically that if you are selling the shares, then the company first, or many times just the investor, have the right to buy those shares. The key is they should be at the same price. So if your friend wants to buy your shares and offers $5 million for your shares, this requirement means that you have to go back to the investor and say, would you want to buy my shares for $5 million? So as long as the investor is willing to buy the same shares for the same price, it's fine. And as a founder, you're not taking risk because you still have the ability to sell at the same price. That's what I would negotiate if I have to, not the fact that they have a right of first refusal. It's also in the company's interest that all founders are subject to this, so that a founder cannot just sell willy-nilly to any third party, right? And if there's a founder disagreement, the founder, to just punish the company, could sell it to a competitor, for example. So you want to make sure that the ownership of the company is restricted to the well-known founder team or the investor that you brought in. Similarly, co-sale rights are fine as long as, again, with the right exemptions, that if you're selling the shares and the investors don't want to buy, then they have the right to sell as part of that, because they're also, again, investing in the founders. And if the founders are leaving the company, then it's fair that investors say, wait a minute, We want to be part of that. We don't want to be part of the company anymore because the founder is leaving, that the founder that we invested on is leaving. So again, nothing to fight about as long as you have exemptions. And the typical exemption is you want to build in somewhere between 5 to 10% carve out, because you will have liquidity. You may want to buy a house, you may have a medical emergency, your kid might be going to college, and as a founder, you've been working for 5-7 years without a whole lot of money, so you don't have savings. So I would negotiate some sort of a 5 to 10% carve out that in an emergency, you can sell the share, get $1 million, whatever it is worth, so that, you can pay for your emergency sort of liquidity events, but not the ability to sell all of it, right? That should be subject to a right of first refusal or co-sale. Again, investors in India or rest of the world outside Silicon Valley tend to, even New York, Texas, tend to focus on founder lock-in, and investors in Silicon Valley don't. So be careful, because this means you can not sell your shares. In most cases, this means you cannot sell your shares unless the founder, the investors approve, which means that just, you can never sell. Forget the right of first refusal. You can't even talk to your friend about buying the shares and then having the investor buy your shares at the same price. This just means you can't sell your shares, period. So fight against that, understand what it means, or bring in appropriate carve-outs. Founder representations, indemnity, again, very important topic for individual founder issues, how it implicates you as a founder. Be very careful, fight very hard. That's why it's in, very explanation points in bold. Again, investors in India and rest of Asia tend to like this. Their perception, as I said, or their position is that as a founder, it's your company, you should know everything that's happening. So if something goes wrong, if the company is not in compliance with any rule, law, regulation, any claim that you didn't disclose or the company didn't disclose, we'll hold you personally liable. In the worst case scenario, this could mean that your house is at risk because the company hadn't made a filing, or the company or the law or something that you should have known or the company should have known was not disclosed to investors. So be very careful about it. Thankfully, investors in Silicon Valley don't tend to push for it. They have appropriate reputations built in for the company to make. And as founders, it's your job so that you're not subject to a claim of fraud. So if there's something that as a CEO of the company or a founder of the company you're aware of, and majority holder of the company you're aware of, you need to disclose that to the investors. But that doesn't mean that you're necessarily taking the risk that if there's something you don't know, or regulation or law, as I said, that you're not aware of, that the company may not be in compliance with, you don't take the risk that suddenly you're personally liable. I mean, my favorite example, and it's obviously a very extreme example, but it can happen in different forms. My favorite example is where an investor came back to a founder and said, wait a minute, there's a regulation, and this is relating to very unique to India, but it can play up in different forms in different places. But there's a requirement in India that you have to maintain, the company has to maintain a register of all pregnant women. Whatever the reason was for that law, I'm not going to go into that necessarily. And it was meant to, I guess, protect pregnant women from whatever harm they may suffer as part of the startup. And obviously founders don't know that. Companies, counsel, or whoever's advising in India didn't know that. And the investor used that to go after the founder, said that you didn't maintain this, and because of that, you're personally liable. And obviously that was in the conflict between founder and investors. It put the founder at a very extreme position where they said, wait a minute, I'm responsible and liable personally because the company didn't maintain a register of, pregnant women. So that's an extreme example, but it can play up in certainly claims. If there's an employee claim that you were not aware of, or if there's a tax filing that, the company hadn't made, and the IRS comes back and says, you now owe $10 million. In this case, because you are agreeing to founder representations, you could be personally liable for that $10 million or whatever the value of the shares of the investor is that's gone down because of that claim. So be careful about that. You should get a written agreement, certainly after you've raised a round of funding, so that your terms of employment are clear. You also want to make sure the terms of employment of your co-founders are clear, and it should always say at will, so that if one of the guys or girls founding team is not working, you can fire them, and they've agreed to in writing that that their employment is at will, therefore, they cannot be, they have no rights if the company decides in its wisdom to terminate that founder. And as part of that employment agreement, also as behalf of a company, we want to make sure, we always make sure that all the founders have assigned all the work they've done from start to the company when the company was formed. And then going forward as part of the employment, they also agree that all the work they're doing as part of the company's employment is assigned and owned by the company. So that's, again, very important to sort of keep in mind and make sure it's in place. And that's, again, to protect the company more than anything else. There are less important issues as part of the term sheet. I put them here as miscellaneous. just so you have them. Those are not some things that you would necessarily fight over. And if you are fighting over, I've listed out the exceptions that you would fight over or how you would sort of qualify the requirements. But as long as you can limit this and work with good counsel who understands these issues, these are not things that I would either have you, have sleepless nights over or worry about too much. This is a list you should, whenever you're talking to your counsel or looking at a term sheet, you should compare it and say, okay, as long as, for example, investors in India require audited financials, and that's a requirement in Indian law. But if they're investing in a US company, you say, wait a minute, we're not having to spend $200,000, $300,000 to get audited financials. It's not a requirement in Delaware unless you're a public company. So why go through that process, right? At least, especially in the Series A, at the early stages of the company. So that's something that, if you look at and scanning through the term sheet, you see that there's a requirement under information rights that investors will get audited financials. You say, wait a minute, it's more of it's not something you would lay on the tracks for and say, I'm not accepting your investment, but it's something that you'll have a discussion with and say, do you really invested? You really want to spend 200, 300,000 of your money and 3 months of our time building these audited financials that are not legally required under Delaware laws. So it's more of a matter of discussion and getting them to understand all that. As I've mentioned, dividends is an important thing. It's part of the, the initial financial discussion we had, but as long as, again, it says non-cumulative, you should be fine. I think we are over time by 5 minutes, so we have another 25 minutes and we do have questions. So with that, I'm going to take a break. In the sense of really let Lloyd sort of take over and ask questions, and we can do this interactive between Lloyd and I. Whoever on the other side will be asking questions.
Awesome. That was fantastic, Anil. I learned a ton. Good information here. Let's take
Hopefully I was able to confuse you enough to want to call a lawyer to say, wait a minute, I do need someone to help.
I think you confused us enough where we had a bunch of questions come up, and there's a lot of questions, and there's over 250 people still on the call, super engaged. So let's take some of these. So starting from the bottom here, or the last slide, you talked about founder vesting. Are you suggesting that one day after a Series A, the founder owns nothing and has agreed that their share allocation vests over 4 years? Or what was, how were you thinking about that?
So good question. But again, vesting is different from ownership, right? So let's be very clear about that. The founders will own whatever the shares they own before the financing, whatever you agreed on. So that's not going away. You continue to own it. What we do is put in the right that if you leave over a period of time, the company has a right to buy back those shares, some portion of that. So typically, let's say it's 4 years. And if you've been working for, let's say, a year in the company, I would negotiate on your behalf to the investor council and say, wait a minute, the founder's been around for at least a year. So let's have 1 year vested and let's have the rest of the shares vesting over remaining 3 years, right? So you have, let's say you were issued 4 million shares initially, right, as a founder. So you would, and you've been, let's say, working for a year. So at that time, you have 4 million shares. You own the 4 million shares outright, right? In terms of ownership, nothing's changing. All you're doing is contractually agreeing with the company, and the founders or the investors are requiring you to agree to in writing with the company that if you leave, then the remaining 3 million, so 1 million, let's say you negotiated is fully vested on day one of the investment. The remaining 3 million will vest over 3 years. So what you're saying is, let's say if you leave after 1 year after the financing, which is 1/3, you lose remaining 2 million shares, right? So that's what you're saying. But ownership wise, if you continue to work for the company, you continue to own those shares and continue to vest in those shares. Lloyd, is that clear? It is an important point, so I just want to make sure everyone understands.
Yeah, that's pretty clear. Earlier you said, be careful of milestone-based investments because of future discounting. What are some terms that satisfy the investor here while still giving company protection and upside?
Yeah, so firstly, you want to make sure that the milestones are very clearly defined, right? So many times investors will say on milestones to be agreed between investor and company, right? So you're taking the risk. So let me step back and again explain what my concern with milestones is, right? My concern with milestones is that, as I said, the company, let's say the investor says we'll put in, as I was saying earlier, $5 million, 2 million now, 3 million later. And the valuation of this is 20 million, right? So you've got 2 million coming in. The company can use $2 million, but the company cannot use 3 million because the money is not coming in at today's value. And let's say the investor says the remaining 3 million will be payable or will invest only upon milestones that we agree in the future. So 6 months later, the company is doing well. You can raise money at 50 million valuation. the investor will say, wait a minute, you can raise from other, but our 3 million will still be stuck at 20 million, right? So you're losing the value. On the one hand, you're not getting the value of the investment on day one. On the other hand, you are having to issue shares that 3 million at the original 20 million valuation. So that's what you're losing out. In terms of what milestones, I like to have them defined and agreed upon up front. So let's say many times, it would say about, signing customer contract worth $5 million. So it's a tangible, target that that, whether you agree or not, but what you have to go to get there. Secondly, it should be time bound. It should say within 3 months or 6 months. It's not infinite, right? So it can't be like 12 months later, you're raising money at 50 million valuation. Investor will come and say, wait a minute. Thirdly, to balance it out, we should also say that if we meet the milestone, then you are obligating today. That it's not that, you may, but I like the word, and English language, provides all this, right? I mean, if you do this, if the lawyers are careful, it should say shall invest. So shall invest means they're legally obligated to invest if you meet the milestone. So at least you've got their commitment that if you meet that 5 million revenue target, you'll get another 3 million. So you can plan around that, right? I mean, rest of it is for you to manage and achieve. Clear?
Definitely. And so the ideal scenario is no sort of milestone based investments, ideally.
Right. Ideally that, or you say, and if they're not able to limit it to tangible or a certain period of time and certainly an obligation on the investor part to invest today, then you say, wait a minute, let's take the 2 million now and we'll deal with the 3 million later. Because keep in mind, if you met the 5 million threshold, your valuation is going to be 50 million, let's say, right? So if this investor doesn't invest at 50, you'll probably get others to invest. So you will end up saving a lot of equity in the company for that.
Definitely. If you can't agree to a valuation, how can safes be used to determine a valuation at a future event? And do you even recommend safes over a price round?
So this presentation is all about, assuming that we are beyond the safe regulation, right? We are at a point where we are negotiating with the VC investor. Safes are very good. We recommend almost all our clients end up, start with safe investments. Those are very good to get the initial seed money in, right? And again, as I was mentioning, so when you're doing an angel round, friends, family, and my target rule of thumb used to be anything less than $500,000, but we live in a very different market now. So anything less than $1 million, I would say, you do try to push the investor to get a safe because it's easy to do. You're not setting the valuation will be set in the future. So as long as you have a reasonable valuation cap and you're not having to go through a legal sort of process of diligence and negotiating the rights, all of these rights with investors, it's a 2-page document, says investors investing, let's say 2 million today or $1 million today at a 10 million cap. And that's it. So whenever you raise money with an institutional investor where you go through all this process of negotiating these terms, the investor that has $1 million safe will convert that $1 million into the same terms that you negotiate with the lead investor, right? So it avoids having to negotiate all of this early enough where it doesn't make sense. And you can close very quickly with these angel investors. Again, the key part there is make sure you don't sign up to something that can be a roadblock in raising your Series A.
Definitely. How common is safes beyond that, like at the Series A level and so on?
It doesn't make sense to have safes after that. But again, if it's sort of a bridge. And, when I started practicing at Cooley in 99, I remember my partner said, usually it's a bridge to nowhere. So if a company is doing a series after Series A, if you see a company doing multiple rounds of bridge, safe financings, it's really that the company is struggling to get to that milestone, whatever it is, to be able to raise the next round. So if you have the leverage, if you have, if you raise 5 million of Series A, and you're going gangbusters, you're selling, your revenues are up, you're building the team, everything's going well, there is no reason for you to look backwards and try to do safes. Go forward, raise more money, close, and then paying 25, 30, 50,000, whatever it is in legal fees, going through a month of diligence because the company is set up properly, so it's all easier to handle. That's not as much of an issue as getting the money in and issuing equity without having to worry about future instances.
Definitely. Makes sense. Can you speak a little bit about anti-dilution, ratchet clauses, and how should founders think about it?
Yeah, don't think about it. I mean, anti-dilution just means that if the investor is investing today at $1 a share and the company issues shares in the future at a price that's lower than $1, then the investor's investment today will be restructured into a conversion price will be restructured. As I said, don't think about it as long as it's weighted average, broad-based weighted average. What that means is it's triggered based on a proportion, and it's a formula. So I won't get into necessarily the whole formula, but the concept is that it should be based on a proportionate amount. So if you raised $1 million from the investor today, and your next round is $5 million, the full ratchet is bad, and that's what you walk away from. If the $5 million round is at 80 cents, your 1 million should not be brought down to it, or the reverse of that. Let's say you raise 5 million today at $1 a share, and you raise $1 million at 80 cents, then the entire 5 million should not be restructured into 80 cents, right? It should be restructured into 1/5 of that. So as long as you have a broad-based weighted average, you're fine. If you have a fully sort of full ratchet, then that's negative, and that's where you walk away. But other than that, as long as it's broad-based, don't worry about it. Every investor will have a right. And also, we do exclude out issuances, obviously, to options, right? I mean, options will be issued at a price lower than what the investors are investing. Many times you'll take a debt financing from Silicon Valley Bank or someone, and you issue warrants, right? And so you want to exclude out all of those. And there's a agreed upon list of exceptions. Again, good counsel can walk you through those. As long as you have those reasonable carve outs into your anti-dilution and it's broad-based, you're as good as you can get.
Definitely. Can you cover market standard for new employee options and financing? Like, are they placed in pre or post money valuation, and how and when is the number of options decided, etc.?
Yeah, so that's great point, and I put that in the post money valuation. So I would go back to that. It's very important because it affects the percentage ownership of the founders. So almost always, and when I say almost always, from my perspective, always, but there may be an outside case. So I want to keep that on the outside, not for this discussion. So almost always, investors coming in will want to have a percentage of the company on what's called fully diluted basis. And almost always, as the red line here says, including an option pool representing X%, right? And it's very standardized to say at this time of Series A, for example, that will be 10%. So what they're saying is basically that when we invest, when we put in our $5 million at 20 million valuation, that assumes that we will get, pre-money. So we get 5 out of 25. So we get 1/5 of the company, 25%. That 25% we will get assumes that the pre-money cap table has a 10% option pool built in, right? So it's important to understand that because it affects the percentage ownership of the founders and everybody else. And that's something you don't find because they will always want to see a snapshot of where they are after the fully diluted dust has settled, right? After they made the investment. The only question is whether it should be a 10% or a lower or a higher percentage that's allocated. And typically it's 10%, but that also should be part of a discussion you have, a business discussion based on your hiring plan. So I tell the founders, right, the way to think about it is, if the founding team is very strong, if you have 4 founders, for example, and you have the CFO, the CTO, the CEO, the chief business person, the chief engineering person already as part of the cap table, and the plan is that you don't need to really hire big ticket items, employees, and just rank and file engineers, then you look at a lower option pool, right? You go to investors and say, we don't need more than 5%. The key is to have whatever is needed to get to the next level. What investors are saying is we will not take dilution for those issuances. We assume that those people are already in the company and will be issued these. So allocate those before we come in so that we get our 25% after we put the 5 million, right? That's the concept. Whether it's 5% or 10%, somewhere in the middle at the Series A level is part of your hiring plan, how strong the founding team is, and then negotiating with investors with that data.
Then coming to negotiating on value and so on with a VC, what are some best practices there? Does a founder need to come up with a valuation, hire a firm to do the valuation before they talk? At what point, how should a founder think about that?
Almost always, again, you would have that into your presentation that you're looking to raise X amount at a certain, and I would always suggest that don't put in the number, put in a range, right? And put in a higher range because now don't go crazy. Don't say $1 billion on Series A. It doesn't happen. And unless, again, you're Mark Zuckerberg and starting a company and maybe you'll get $1 billion valuation right off the bat. Look at what the market is, right? So that will determine, and doing your homework is critical to getting that number of the range, right? Put a range, but it has to be a reasonable range. It can't be somewhere between 5 to 20 million, right? That's a crazy range because how do you get through that, right? So if you say somewhere between 20, 22 million and justify, and again, have a finance person build up valuation and the financial model on you're raising $3 million. Your presentation should say we are raising 3 million at, let's say, 20 million valuation. Here's what we will deploy the money for, and here's what we expect to get, for the investors to get. So we will raise another 10 million in 6 months with this 3 million in, and at 50 million valuation, right? It's very important to think about investors, what the investors want. Investors want, and I'm going to pause and go slow because conceptually it's very important for founders to understand. Everyone's just streaming through, Investors want to put money today at a low valuation that grows and that they can sell at a high valuation, I've not said anything that you don't know, right? As an investor, but please pay attention to that when you're building your plan, when you're building your presentation. When you're going in front of investors, as a founder, it's your job to walk them through one way or the other. Be creative, use data, use the right model, but your job to sell that concept that if you invest today at this low valuation, this is how we will use the money. This is what we will do with that money. This is the time period within which we expect to get to this valuation, which is 3x of what you're investing today. And this is how, right? This is the pattern, this is technology, this is the team that will execute, right? If you can draw that, you will get funded. Why would an investor not invest in a company that says, if you invest at 10 million today, in 6 months, you'll be 30 million valuation? It's their job to get there, right? And you're helping them. So your job is to make a presentation that's clear, takes them from where they're investing to the high valuation and how you get there, right? It's as simple as that in terms of conceptually. Please pay attention to that. Everything else will sort of fall through, fall together.
Definitely. Any recommendations for setting valuations? What have you seen there? Like what tools or mechanics startups use typically?
Again, at the Series A level, you probably want to, there is pitch book. There's a lot of data on what other companies, I keep saying, there's all that investment. There's also information on what the investor you are talking to, right? Again, a $2 billion fund is likely to give you a higher valuation, and a $10 million fund is likely to not give you the same valuation. That's just basic, sense. But look at also what market you're in, right? If you are in sort of right now, remote monitoring, healthcare, whatever it is, it's hot, right? And if your technology is working and you have patents on it, that's the other thing I say, in your presentation to the investors, file, if you're a technology company, you are foolish not to file patents, you have to. Talk to a patent lawyer, and I always say the few $1,000s that you invest in that patent filing will have 10 times at least more valuation on the slide. When you say we filed 3 patents, the investor looking at that, they're saying, wow, this company has technology they believe in. And it may be that, if their patent is granted in this remote monitoring, they have a lock on a 10 billion or a maybe $1 trillion market, right? That's how excited it can become. And you can also, if Google tomorrow decides to be in your market, Google will have to buy you out to get your patent, because now Google cannot get in the market. So there's a huge value in patents. So build your, your presentation around all of those. As many solid, tangible bullet points you can put, the better for you from valuation perspective. So it is your job to come up with a range based on all of this data and then negotiate from there with investors.
Definitely super valuable information here. Do you typically see right of first refusal or right of first offer? Can you speak to the differences between the two, and can it create a bidding war, etc., those kinds of things?
None of this should create a big war. If you're an investor, a founder looking to raise investment, and you're talking to the right VC, we always find a way to get through this. We are doing like 3 new term sheets from yesterday to today, and they're all good counsel on the other side. We have calls, we understand where the issues are. Obviously, some issues are unique to certain investors, and we understand because they've been burned with some particular issue. For Khosla Ventures, for example, they've been burned with some founders, so they're focusing on how the founders play out all of this, control and decision making. It's just something that you're not going to fight. If you're going to take money from that investor, you have to know that that's what you're getting into. For example, some investors will invest more, as I said, because they don't care about the money as they're investing. They will look at 100 investments and say no if they have to. And they will invest in one, but once they invest, they will double down on whatever valuation and want to clean the market with, their investment, right? So those are things that you can help yourself with. As far as right of first refusal, ROFO, right of first offer, Asia-based investors prefer ROFO. In Silicon Valley, ROFR. So by logic, ROFR is better for the founders, which means really that you can go and talk to a friend and get an offer, right? Or friend or whoever, and get an offer. All you have to do is say, hey, investor, I have an offer. You want to match it? You have 30 days. And then you have the ability to sell your shares to that investor, to the existing investor at the same price. Or if they don't want to buy, then you are free to sell. So that's good. ROFO is a right of first offer where you have to go to the investor and say, would you like to buy my shares? The problem as a founder you have there is you don't know what the value is, right? So you work in a vacuum and saying investor make an offer, and you have the right to make the first offer, right? And typically investors have less of that, and strategic investors, if you're working with Google as an investor, Google puts money, they will almost always, Amazon be working with on an investment, they almost insist that they have a ROFO because they want to be the first ones that you talk to if you were ever thinking of selling the company. And that's okay, again, if you're careful in crafting a ROFO, where you say, okay, you have a right to, you have a right to get an offer first, but in 10 days, if you don't make an offer that we like, we can run away, go to other party. So as long as it's structured properly, ROFO is not as much of an issue. But again, work with good counsel, understand what you're signing up for.
Awesome. On pro rata rights and new financing, how do you navigate situations where later stage investors ignore existing investors' pro rata rights?
Well, that's why, firstly, you don't care, right? I mean, you are the founder company. Your friend is the new investor that's putting in money. As I said, once you're breakthrough in Series B, Series C, these investors want to put $100 million, $200 million, $1 billion, $2 billion valuation, right? That's where you want to head. Your investors, I'm just being, just open, very straightforward about this, right? The investors that put in the $500,000, the angels, their job is done by that time, right? And you should basically in your mind say, dude, you've done your job. I got your investment at 10 million. I've raised it to 200 million valuation. I just now sit back and wait for the check to cash in. That's their job. Your job is to make sure they understand that, right? As soon as you open the door and let them come in with this right, that right, it will become your job very difficult. It becomes my job very difficult to then negotiate those terms away from, and your ability to help you in your ability to close with the big investor that's putting more money.
Awesome. We'll take the last few questions. You talked about warrants with debt investors. Can you tell us a little more about that? How does that work?
Yeah, I mean, that's a separate concept. I just said that should be excluded from, the right of first refusal and that dilution. But basically, Silicon Valley Bank would, for example, come in and say, okay, we'll give a loan for 2 million, 5 million, whatever it is. But they're also taking a risk. So as part of that risk taking, they'll say, because we're taking risk, we need some upside. So we will need a warrant. And warrant is really an option to buy shares at typically a pre-agreed price. So they'll say, okay, we'll take, when you're raising your Series A, if you raise your Series A, and it's good to look at other options because they're non-dilutive. Silicon Valley Bank, instead of raising another 5 million from, let's say, another investor and diluting the company at early stage, you can go to Silicon Valley Bank and say, can you give me a loan for 5 million, right? And maybe they'll give. I mean, that's obviously they have to go through their diligence and all that. But if they agree to give you a loan for 5 million, they'll say, that's a low risk we are taking. For that risk, we'll want to get options to buy, let's say, 500,000 worth of, or 250,000 worth of Series A shares at the Series A price. So what they're saying is that we have the right to buy these without paying anything right now. And if the company valuation goes up significantly, then we will exercise this and we are in the money, we make money. And if the company is not going anywhere, then we just shut it. We don't exercise and we don't pay anything, right? So it's a sweetener for them to come in and sort of an upside for them to take the risk of giving a loan.
Awesome. And the last one here I have is it best practice to determine valuation based on, I mean, it's back to the valuation question, but, determine valuation based on revenue. If so, what are the typical multiples in Silicon Valley versus other parts of the country? Do you just multiply like a 6x, 10x revenue, that sort of thing?
It depends on what market you're in. If you're a SaaS enterprise, yes. I mean, because your revenues, the key, with SaaS companies, investors love that, right? It's a subscription model. If you can prove that a large company is a customer, or you have 5 customers, large companies, investors will give you that 5x, 6x, maybe even in this market. And when I say this market, subject to COVID, how that plays out, even higher, right? I mean, because it's very important for you to, and founders know this already when you're building your business. If you're a SaaS business, you've got hooked on, you've got customers, large enterprise customers, it can only go up, right? With very little sort of new investment to make in terms of the actual sales, right? So if you have Cisco buying your product for all their employees, you're golden, right? So the valuation of that is, how do you multiply that, right? It's for the rest of your life, or 5, 10 years, whatever you run the startup, you have that money coming, it can only grow. And if Cisco's buying it, obviously then Oracle will buy and Facebook will buy and all of that, right? So the market is clearly there, and you've proven that a large company with, understands technology, has a, buying power to buy and evaluate your technologies, has agreed to buy. The rest of it is very easy. Those are companies that, that you hear about, that suddenly they raise $10 million and then in 12 months they're raising $100 million or $200 million, right? Because of that model, that they've proved that they have 3 or 4 good enterprise customers, and then basic, conclusion from that is they have $100 billion market potentially, because that's how big the enterprise market is, or can be very easily for SaaS companies. So it depends, right, on which market you're focusing on. Yeah.
Thank you so much for joining us. This webinar series is brought to you by Boast AI Launch Academy in partnership with our friends at BCF Ventures, Lazaridis Institute, and Founder Institute.
I need some traction.